If somebody is telling you that this is the time to invest, or by the time in June, sometime in June, this is it, this is the end of the bear market or whatever correction that is there, I wouldn't bet my pants on those kind of opinions. First of all, it is possible that after a third month of selling, which means we are down in April, May, now this is June, you do end up with a trading bottom at the end of the month and get some kind of a trading rally into July. Though July is going to be earning season, so it's not going to be that simple. So it's too early. And the other one is, when do really you call a bear market? You wait for a 20% decline to call a bear market. When I was trying to say that I went all cash at, when we broke 17 to 80 or something, was the 20-week average sometime mid of April. Moment we closed below that, I said I'm all cash 65%. By me, I'm 85%. Now, moment I said those things, people are saying, oh, it's too late. Stocks have already crashed 50%. Now, how much have they crashed? Are you going to wait for a 20% Nifty decline to say that you are now it is a bear market and now you should sell your stocks because they are down 50%? What is the use? So one of the first things, if you come into the market, I think I started at the age of 18, started to track prices. 1990, it is just around the Gulf War, before the Gulf War period, or around that time. And the first things I figured is that one of the things most investors grapple with is the exit. And so the first book, of course, was an investment book, but soon after, I think two books later, I found a book, and these were, of course, available then, and maybe even now from Vision Books was the only low-priced printer. In fact, there were no books only in India, so they were the only ones putting out technical books. And so there was an investment book by Donald Cassidy, said it's when you sell that counts. Now, by the name, you'd think it's a short seller book or it's a technical book. Neither. It was actually a book for investors with a whole list of pointers, like a checklist, to decide, if you meet all of these pointers, then it's time to invest. So if you meet all of these pointers, it's time to sell. And so it sort of gave you a checklist of things that happen, what people talk at parties, how do you feel, and went through the entire thought process of if you're feeling these things, if you're observing these things, then it's probably time to book. And so it was building that mentality that people need to have to actually book gains in their investment portfolio as well. So that's something, if you don't have, and if you're simply saying I'm a long-term investor, I'm going to sit through 50, 60, 70% drawdowns, it's fine if you have a 100-year holding period and you're sure that the companies that you own are not going to get wiped out. But it does make a huge difference to your long-term CAGR if that really bothers you. If you're able to at least identify those 1 in 8 year, 10-year times when you get a serious bear market. At least that's been happening more recently. It probably would not have been the case prior to the 1980s. You wouldn't have, or 1990s, you wouldn't have seen this kind of a bear market for maybe 2 decades. And so there are those phases, and then there are these phases. So the whole point being that if you learn a little more about market analysis, you can be ahead of time in identifying potential market turns. And one of the reasons I waited till April, a third time that you went back to 18,000, is just that. The previous correction did only around 15-16% to the lows in March. So it was still not looking to me that you'd go beyond 20%. The third time give up was that the setup was there for something to turn bad. Now, how bad? It doesn't really matter. As long as you can identify that something worse can happen, the first step is to do risk management and then figure it out. So that's how markets have become. You can't say exactly this is the level at which it's going to bottom out. So is it going to be 14,500? Is it going to be 12,000 or whatever? It could be anything. The point is it going to be that bad is the first thing. And once you identify if things are going to be worse than normal, then you do risk management first and then figure out what that worse than normal is. You can always figure out when you reach that destination, right? Because if prices have fallen more than 20, 30, 40%, you're there, and then you have news, events, analysis to do to figure out whether you've reached the other extreme or not. So learn to move in advance. I think that's the main lesson, especially for first time and new investors in the market who haven't really figured it out and are hoping that they just invest and 5 years down the line they'll double their money and come back. And sometimes it's not that simple. What you think is 5 years can become 20 years if your timing is bad.